And so at the end of the day, I think it's much higher inflation, a much cheaper dollar. He even said it himself last week. He said a much lower dollar is beneficial for his economy. And I, as a gold bull, just had a grin from here to here because in the end, that's extremely bullish for that and the many other reasons to be bullish on gold.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're digging into the fast-moving world of precious metals, mining, and market insights. I'm excited to introduce Peter Grandich, a renowned market commentator, former chief market strategist, portfolio manager for 4 hedge funds, and he even started a mutual fund that bore his name. With over 4 decades of experience in finance and a keen eye for resource sector trends, Peter's built a stellar reputation for his bold market calls and deep understanding of metals and mining investments. Peter, it's a privilege to have you back on Metals and Miners. Welcome to the show.
Thank you very much, Gary. It's as much of a privilege to be a guest as well. Thank you.
I appreciate it. All right, Peter, let's begin with the current administration's pivot away from the austerity attempt to trying to grow faster than the debt. President Trump signed the big, beautiful bill into law. By various rating measures, it adds another 4 to 7 trillion to the debt over 10 years. So we'll just call it 500 billion or so annual increase to the already 2 to 2.5 trillion annual deficits. Deficit spending is clearly here to stay. It's being doubled down on. Our debt to GDP ratio is over 120. Last seen around World War II. That's typically danger territory, although we have the reserve currency. But their plan is the plan is to lower that and then unleash higher growth. As long as the growth as a percentage of GDP is higher than the debt, the ratio should come down, but the debt load is going to increase. What are you monitoring that could go wrong with this plan?
You need a calculator to add up all those possibilities of what can go wrong. I think you can start right at the top that it would be unprecedented for the level of growth, which would be well above 6%, and not 6% a quarter or 6% a year, but for many, many years without any interruption to really generate enough cash flow to not only get past the deficits, but to reduce the principal. I think it's a foregone conclusion by most in the world that America is never going to pay off or back its 37 trillion in debt. I think the bigger concern, which has grown and why it's hurt bonds and helped gold for the last several months, is that there's real concern now that we're going to get to the point where even paying the interest can be a challenge. I don't think you can grow out of it. B, I don't think you're going to find others. Let's face facts. Some of the key former folks that would take a lot of this debt are either selling it or have their own problems. China has shown to be greatly liquidating their holdings, once one of the largest holders of our debt. And one of the biggest has its own issues, and that's Japan. And so it's great talk, and I can understand people, some getting excited that somehow Trump can magically grow the economy that way, but it's not conceivable in the realm of reality. And it sounded great. And let's not forget one thing, because Trump likes to forget the things that didn't go right and hop on the things that went wrong. It was just right after his election when he was sitting in the White House with Musk talking about how not only the deficits are going to disappear thanks to Doge, but the debt was going to disappear. Yeah. And then they struggled to even get $9 billion in reduction. So I think that the bottom line to that, it's nice talk, but talk is really, really cheap at this point. And I think it's a challenge that's impossible to achieve. Sounds good now, probably can get away with it for a couple more quarters, but eventually people realize the impossibility to grow at 6% or more for 5 or 10 years in a row is just not going to happen.
Yeah. Okay. So in addition to that bill, Additionally, they're securing tariff deals with countries around the world. The biggest just happened with the EU over the weekend. Investments into the country, investments in purchasing our military equipment, freer and more open trade. Growth looks likely, maybe not to the 6%, but growth looks likely. But so does increased deficit spending. What is the net result there on inflation, commodities, and the precious metals?
Well, I take exception to those that are saying that he's winning the trade war. Certainly, if you compare it to his notes and what he was saying before he took office and shortly after, what we could expect and what the net result will be. In fact, right up to this European deal, none of the deals have really shown to be anything worth talking about. Even the Japanese deal that was announced, Japan has subsequently come out and demonstrated that basically everything Trump said was off the mark. And that's their nice way of putting things. I'll also point out that while the European Union deal looks good and may be the first one that he's achieved that is actually something, it has to be ratified by the members of the European Parliament. And every European country that has spoken since that deal says this is not a deal that's good for us. So I don't know how close that's going to come to actually getting done. And I'll just say this. I like some of the things that he's done outside of the trade, but I think history will show, and it'll take several years from now, he made a big mistake by taking a big stick into this versus an olive branch. He's actually probably caused the person who's ever in charge of new membership at the BRICS a big smile because more countries now than ever are going to want to join it. I think at the end of the day, America will have less friends around the world, economically, socially, and politically, than it did beforehand because of how he's approached this trade war.
Okay, so that's an interesting take. But on the other side of it, on the ledger side, with the way things are going with the debt, inability to pay it back, a way to pursue austerity and attempt to grow our way out of this. Clearly, inflation is going to be an issue. What do you see as the net result there with inflation, with commodities, with precious metals? And that takes into account not just his policies, but what he's inherited as well.
Yeah, and it's important to note that what he inherited, let's face facts, he inherited the previous 4 years administration did more to damage America economically, socially, and politically than all the presidents in the last 100 years. There's no doubt of that in my mind. I'm neither a Magna or a person that has this Trump disease. There are things I think he's done well, and clearly immigration was one of them. The problem that I think is that America does not understand how broken we are and how we're really in a two-tier economy. And let me just explain that quickly. They say about 10% of Americans, the highest 10% worth, own 86% of all the assets. The next 40% in worth own the remaining 14, and half of America doesn't own anything. The only people that are experiencing really good times and probably say, hey, the economy is good and all, is that top 10%. Now, Wall Street tends to cater to that group. They give some lip to the other group, the 40% less, but most of it is to that top 10. They have no consideration nor really understand what the people in the bottom 50% are facing. And there, it is really, really tough and getting tougher every day. So I struggle with any kind of expansive economy for any great length of time, and certainly not a believer at all that we're going to be like it used to be, and everybody's going to have a chicken every pot. The other thing that isn't being talked about, and there's so much political stuff and there's so much polarization now that people lose sight of some of the little things. One of the things that I haven't heard anybody explain to me, Gary, yet is he's offered so many different groups the ability to pay less or no taxes. Somebody has to pay for it. It's an old line in the old Wall Street movie where it says, somebody's going to pay for it and it's not going to be me. Well, somebody has to. You can't have all this lower taxes and less taxing. We just had a report come out now, and it's amazing how Wall Street just blows it away. And that is, they're now saying that the Social Security system, which so many people depend on, may be bankrupt in less than 6 years. Clearly, they've taken the estimate of the big bill and say now that people are going to get at least 18% less come the year 2034 going forward, minimally because of the big bill. You're talking about people that are such margin and so dependent that any decline in what they will receive in Social Security be the difference of keeping their head above water or below water. So I just think the picture is not as bright as currently he and many on Wall Street are painting. How that will impact inflation? Eventually, they only have two choices, Gary. I mean, let's call it what it really is. You can either deflate, which might have worked maybe before the 2008 crisis when we had half the amount of debt that we have now. I think that's off the table. Or you reflate and you monetize this. And we are seeing some of the preliminary steps that the banana republics that we used to make fun of in the 60s and 70s, that America has fallen into that trap as well. And so at the end of the day, I think it's much higher inflation, a much cheaper dollar. He even said it himself last week. He said a much lower dollar is beneficial for his economy. And I, as a gold bull, just had a grin from here to here because in the end, that's extremely bullish for that and the many other reasons to be bullish on gold.
So there's a few things in there I want to touch on. I interviewed Maya McGinnis last month. She is the president for the Foundation for Budget Fairness. They are nonpartisan. They work with both sides of the aisle. She did talk about this Social Security issue that you just brought up. And it is something that you guys should go back and watch that interview and listen to what she has to share. But Peter, you're absolutely right. It is projected to run out in 6 to 7 years, and that's without an issue. And so they have not addressed that. It does need to be addressed, and very few are currently talking about it. So it's going to require probably a major issue as the umbrella covering for them to tackle it, but I would expect that to take place here in the next couple of years. The other thing you had touched on was the K-shaped economy. So at the top of the economy, we have those people who own assets, own the overwhelming majority of the assets, and they are doing exceptionally well. And then we have the rest at the bottom, and that's about, 50, 60, 70% of the people who are on the bottom of the K, and they're getting caught in the margins. They're getting caught in the margins as, their credit cards get fully tapped out, or that, the price of everything goes higher, including property taxes, insurance, HOA fees, et cetera. They're getting caught in the margins. But here's the thing. On the top side of the K, you have people who are earning more and more and more because the way the paradigm is set up, all of their assets keep going up in value. And so they could only spend so much on leisure, fun, toys, things like that. And the rest goes back into assets, which is making the assets even more costlier. So the top of the K is seeing assets go up, and the bottom of the K is seeing cost of living go up. And they're using fiat dollars. Do you expect that paradigm that we've been watching to continue for the foreseeable future? And if so, isn't there a brick wall somewhere?
Yeah, well, one of the things that they're also doing, which isn't often spoken about, that most of the elite have been moving their assets out of U.S. securities overseas, particularly into physical gold, has been a major change for them. And you're absolutely right. Eventually, the regular economy, they can't do enough to make up for the people who can no longer even afford to go out and eat. I'll tell you this much, Gary. In this planning business group that I've been part of for 25 years, almost a third of our clients are small business owners scattered throughout the United States. A lot of them in the entertainment and consumer discretionary type of businesses. And they all said, even since COVID has, passed us, that they've never recovered back to pre-COVID levels, and that they're seeing just more and more higher costs, less and less people coming out, less and less times. And you're right, sooner or later, no matter what those upper echelon are doing, the regular economy hits a brick wall. Because what we're seeing it now in auto delinquencies. We're seeing it in the real estate market. Interesting thing I just put out today, Prudential, which is, kind of tilted towards wanting to come out with favorable numbers because they sell financial services. But they came out that the average 55-year-old in America now has less than 50,000 saved for retirement. That means the average 55 person is never going to see retirement. Not in the way that their same financial commercials run, that they live and play golf and swim and do all those things at the last part of our life. So there is definitely a two-tier economy in the United States. It's definitely K, like you said, and it's getting worse for the majority. Sooner or later, even with a clearly more of a person who's clearly more motivated on the economic side than the previous administration was. I happen to like his secretary treasurer, and I can't stand his commerce secretary. And it's a dichotomy for me because one is not worth it's just mouth. It might as well be a promoter for somewheres. But the secretary treasurer has a decent understanding, and I think he recognizes some of the issues. And one of those issues that I think he's talked about in the past, and hopefully by next year you'll be talking about it a lot more because I know you have an interest in gold, is the usage of gold, not only here, that will surprise people how we're going to decide to use it to help sustain keeping the United States going, but what the BRICS are going to end up announcing and using it all. So it is an interesting time, but I think for the vast majority of Americans, they're struggling more now than in any other time in the 42 years I've been in this industry.
Yeah. All right. Well, so let's shift over to the tech sector. The U.S. technology sector has been really the linchpin for 15 years. It's now effectively about 44% of the S&P 500 share. It's the most ever. Since 2018, this share has doubled. By comparison, the 2000 dot-com bubble peak, the weight was 35%. So it's almost 10% weighted even more than the peak of the dot-com bubble. The tech sector is just bigger than ever before. What is going to stop this, or is it just going to go on like this, indefinitely?
Well, it's an indirect cause because of how the stock market has changed since when I started back in 1984. In 1984, almost 90% of the trading was individual investors. Only 10% was institutional. There was no computers. Now, passive investing makes up over half of the money that's in the stock market.
I think you just dated yourself.
Well, it's okay. I feel it as much as can date it. So the bottom line is the market now sees managers not actively managing money, but merely there to track indexes and indices. Part of them, and the biggest part of them, is technology. So let's just look at that half, and it's a little bit more than half. They say it's about 56% now. So a person puts money into one of these index funds, and the manager gets that money, and he or she doesn't sit and go, well, maybe I buy this one or that. No, it has to buy a certain set in order to keep matching that index. And since the index, as you said, is heavily weighted technology, more money goes into technology ones than, say, smaller companies and all. And it kind of comes as self-fulfilling prophecy because as long as that money's net flowing in, it causes those things to rise. More people want to track it, et cetera, et cetera. The remaining half, or about half of the money, 2/3 of it is in some sort of computer algorithm trading programs now. They may be as simple as kick off if there's words and headlines you buy or sell, to very sophisticated programs with stocks and options and futures and all. The smallest majority of the money in the stock market now is what used to be the majority, individuals, investors, buying and selling part ownerships of businesses. So one of the first things I always say to people like me with gray hair and no hair, hey, that market 30, 40 years ago, you can't keep using the same rules and theories from then. In fact, when you watch that certain financial network and their anchor people sitting at the New York Stock Exchange, that might as well be a museum because most of the volume's not even trading there. And that creates another thing that most people aren't aware of. Black pools now of money where major financial institutions used off-market transactions that the public never sees, is really becoming an advantageous way for institutions to trade for a disadvantage for a person or individual like me. And so I think when you combine that with the fact that 2/3 of financial advisors have only been in the business from the last financial crisis going forward, and almost half of them weren't even born when I started, I'm afraid all these things, plus the real lack of experience of a typical, what used to be for a couple hundred years, bear markets. I know it's hard for young people to understand that, but there are times, in fact, when I entered the brokerage business, my broker could not believe there was a young man that came out. You'll enjoy this, Gary. Let me take the minute to tell you. So the Dow Jones Industrial traded between 700 and 1,000 for 13 years in a row, to the point where in 1982, Business Week ran a famous cover, "Equities are dead." And they quoted all the stars from Wall Street explaining, because of everything that's happened in the world, the stock market may never go up a lot again. So some young man that no one heard of named Robert Prechter Jr. came out of Gainesville, Georgia, and he put out a theory on something called the Elliott wave theory, which at the time everyone goes, what the heck's that? He said the Dow's going to 3,600, and they beat him up. 3,600, it's never gone over 1,000. Well, we all know it went a lot higher than that. And the reason I say that is I think we're on the other side of that. I think most people think it can never stop going up now. The vast majority of people who work on Wall Street, even if you just legitimately look at their reviews, all have up years going forward. They can't imagine it not going up, or worse yet, going down a lot and staying down. And so I think we've gone the pendulum swing. And I've learned in life, and I'm old enough to say this, that everything is a pendulum. What goes around comes around, the old saying. And I just think we're at that extreme, at that pendulum, and we have to start swinging the other way. And part of the things that we just talked about, I think, are going to be the cause to make us swing that other way.
Interesting. All right. So, Peter, let's shift over to AI, robotics, the electrification of everything. All of that requires historical levels of metals to be able to work. Mining the metals, you know this, it takes a long time. It takes a lot of capital. It could take 10 to 20 years just to get a producing mine of any substantial quantity. So here we have a situation where, because of AI, because of robotics, because of the electrification, the projections are that we need a historic level of metals moving forward. Yet we did not have the historic levels of investment 15, 10 years ago to correspond, so that now that we're in this moment, we're going to have that output, that producing output. It's been blocked by NVIDIA, Facebook, Google, Microsoft, Apple, et cetera. That's where everyone's attention has been. So there's already metals like silver that have been in a structural deficit for 5 years. Some are approaching a deficit, and we haven't even gotten yet to the massive demand pull that's coming. So my question is how much of a bottleneck to AI, to robotics, to the data center development, electrification, evolution, et cetera, do you expect the metals to become the greater that this demand pull increases?
Well, for the very reason you described, and you did it eloquently, let me add, is why I put so much money in the explorers and developers of these metals. Primarily, my most favorite metal for this year, obviously, was copper, which fits that mode, but there's several of them, including critical minerals. And you're absolutely right. And then on top of all of that, even the ability to currently deliver power has reached its extreme. I like to joke that our grid is so old and so antiquated that Thomas Edison installed some of it. But
That's my,
so you have folks on Wall Street, and when I try to tell them, like you just said, listen, you got to look at, we need metals. And they go, wow, why do I need metals? Okay, you got all these predictions. AI is going to do this. There's going to be this much demand, robotics and all. Not only how you're going to get it there, the power, but where you're going to get all the metals from. Do you know that you can't spin a globe anymore and just go like this and go mining there? The world has shrunk, especially for the majors. They are not going back to certain places in the world that are currently now very unsafe socially and politically. I'll give you just a real quick example. I won't give you Pacific stocks. West Africa, when I was a money manager, that was the hottest area to invest in. The gold companies were going over there, the stocks were rising. And about 7 or 8 years ago, I concluded, man, they're gonna start nationalizing over there. You can just see the change in the governments, and people say, nah, well, we just saw a company like Barrick lose 100 million in gold because the country of Mali decided to come and say, you don't own it, we do. Took a helicopter and flew out with 100 million. So I say that point is it's a lot harder to find metals, even if, and we're not there, we have a well resourced, well ready to go major mining companies who will tell you both privately and I think publicly. Take, for example, copper. The grade of copper being produced in the world has shrunk in half now. So we have to move that much more rock just to get the same amount of copper that we used to get several years ago. They say that we're going to need a price not north of 5, but closer to 6 or 7 and sustain before they're going to be willing to commit billions of dollars to go and find copper. And thankfully, the only good news in the mining over this is politicians have realized how shortchanged they've been and how negative it is. And now they're finally getting around to things that should have been done 10 or 20 years ago to try to regulate and get things better off so it doesn't take 15 to 30 years from the time you first find something and develop. So
You know,
I'm sorry, you're absolutely right that if you're going to buy the AI and robotics story, and I'm not here to argue it, bullish, whatever, you have to be also be bullish on metals. And yet most of those same AI people and all are negative about metals,
well,
which doesn't make sense.
they'll get bullish real quick when when the bottleneck hits. But you know,
Absolutely.
to your point on the copper that you're hearing from the experts that it's going to require sustained prices over $6, $7, $8. You know, I was listening to an interview of a pretty good sized silver company. The CEO came out and said, look, we know where there's some additional silver on our land package. And so does the other ones of equal size to us. However, $40, $50, that's not enough to get it out of the ground. You know, we're looking at something closer to $100 because not only the cost, but you got to make some profit on it. So yeah, we know where it is, but also when the price finally starts moving towards that number, it's not like we could just turn on the drills and go get it. It takes time. There's planning, there's permitting, so what he was saying was, you know, it's going to take $100 silver to get to that harder to reach silver. However, once it hits there, there's still a period of time before everything gets turned on to get the metal out of the ground. So you're looking at probably even higher silver costs. And I would imagine the same thing is going to be for copper in that sense. So, okay. So Peter, gold has had a really nice move since its breakout over 2000. The last few months, it's been sitting in this consolidation range. Some experts are out there saying, you know, look, there's going to be a pullback and it could be as much as $1,000 an ounce. We're way overstretched. It's, you know, we're way overstretched over the 200-day moving average. Others are saying the opposite. They're saying macro conditions haven't changed. And this, you know, when it breaks out again from this consolidation period, it's going higher. What's the case for gold moving higher from here? And why do regular investors who don't own any need to own some as a percentage of their portfolio?
Well, I'll answer the second part first, and that is because we have a financial service industry that treats gold like kryptonite, and it goes against their main product and desire, and that's financial assets. And I don't ever expect that to change on the financial service industry. That's why here in the US, particularly, Americans underown gold related investments, unlike any other area in the world, particularly Asia and all. So I don't expect that. I only expect that to change a little once those numbers that you spoke about are seen by everybody, and suddenly other friends are telling them, hey, did you own this guy? My friend told me to buy this gold thing and all. We're not even close to that yet and all. The first part about where gold can go, I'll first go back to just remember that Robert Prechter story. That's a lot of people's thinking now about gold. Hey, it traded for so long between somewheres. This was just an aberration. It's going to go back. It never really should be over 1,000 or 2,000. Therefore, it should come back. The moving average was an argument. That's what got me to sell my physical gold near the top, because we got so far ahead of the moving average. But in that 3 months that you've spoken about, the 200-day has gone from under 2,700 now approaching 3,100. So it's getting to the point where technically it's almost corrected enough to not have that concern about, being too far ahead of itself. I think it's gone through just a masterful consolidation and corrective phase. I'm glad that there's people like you said. Now, not everybody's raring that it's going to the moon. I think technically the damage at the absolute worst would be down to the 200 days. So that would be around 3,100 now. But I do think that people have not grasped what really's been the key change outside of things like bricks and all. And that is the physical market, which was highly manipulated by these paper people that lived in London and New York. Because it moved the physical market to Asia, gold has become a primary source of worthiness to them, and they don't trade paper in the way that the people at the Crimex, I would call it, the Comex, has for years. The changing of where physical trading is taking place and how it's changing has greatly curtailed how the paper market would be suppressed and hold back the prices in general. And I think that's a terminal illness that is done. They're not going to be able to reverse that because it's been taken away from them. They don't have the influence that they have. So I don't think anything past perhaps a few more weeks of this sideways movement, and even like you said, some type of downdraft for some reason down to the 200-day, that's the worst case scenario. I think most of the upside potential is still to the upside, because the people that have the money are the people buying gold. I don't get into, because I don't want to argue about Bitcoin, and I hear every day somebody from Wall Street, I get the calls why I have to own cryptocurrencies. And it's true, Wall Street is putting some serious money in it. But the money that the central banks have combined towers over what Wall Street has. They're not only not touching cryptocurrency, they're using only one product, gold, and gold in the most aggressive way. And they are not in it to make a trade or flip it to somebody someday. They're doing it because they know there's a change coming down the road, and that it's going to have to be whatever it is, either these limited regional trading partners or worldwide, which BRICS is going to grow into, in my opinion, is going to need some sort of hard asset to make people trust whatever they're involving their paper assets with. There's not going to be any more 100% fiat currencies. And therefore, that's why they're purchasing the gold and all. They know it's coming. And the surprise here is going to be that I continue to believe that the talk of a gold-backed treasury bond and repricing gold in order to create more liquidity, at least on America's book, is something that's going to happen between now and next July 4th. I'm convinced of that. And therefore, that'll enlighten people just as copper has. You know what's amazing, Gary? Let me take 30 seconds to tell you this. When Trump announced the tariff, I didn't think it's going to stay at 50%. I think it's going to end up lower than that. But it caused so many people in the investment community and the general public going, what's all this problem with copper? And when they looked into the copper story and saw, wow, I didn't realize there's such a big supply and demand scenario, it interested them in copper. That's going to be part of the thing that's going to interest people in the gold. When they see the government end up using it, then maybe some of the people on Wall Street will start to, use it and put it in portfolios.
So that is the Judy Shelton recommendation was, for next July 4th, the 50-year gold-backed bonds. So it'll be interesting to see what takes place and who ends up taking over the Fed and what their narrative is there. But it's hard for me not to agree with you in some sense that, the world is moving towards some way of moving away from 100% fiat and having some real tangible assets in the financial system in some capacity. But Peter, let's move to Newmont Mining. I'm sure you saw this. It blew away analyst estimates again. The stock closed at a 52-week high. Investors sold investors sold. So Newmont closed at a 52-week high, but investors sold another million shares of GDX, and shares outstanding fell to another 52-week low. So clearly, like you pointed out earlier, this is the opposite of any kind of speculative bubble. What are you watching and expecting to trigger the investment herd to move in to the mining shares with both feet? They're making money hand over fist.
Well, the competition still is great. The general stock market, whether it should be there or not, whether it's overpriced or not, is still trading near record highs. And the cryptocurrency market is the biggest negative for all things related to metal, from physical gold all the way down, especially to the junior resource market. And that's still pretty well going strong. So the fact that they even managed to do what they've done has been an accomplishment, quite frankly. The important thing to recognize is that those businesses, and Newmont's certainly not alone in it, they're basically printing cash. Their record free cash flow is going to continue for several quarters. Their balance sheets are pristine now, not like they were in the last bull market of 15 years ago, where they were indebted and they borrowed so much to buy prices at the top. So these type of companies, and these are the companies that people are going to eventually turn to and go, you got to help us. We got to find these metals. And they're going to be in a good position to good to. I think it's going to take, there is some flow. It's not from the U.S. investment community. We are seeing people outside the United States getting interested in these things. But until the U.S. stock market has at least a decent correction and or cryptocurrencies, it's still going to be a struggle for the mining industry and exploration to attract. Remember also that when you don't have a bull market for 15 years almost, there was a little blip in 2020, but it wasn't long enough. A lot of people in the industry that used to be involved in the metals left. There's far less mining desks now. I would argue there's far less investors now than there were 15 years ago. So that takes time to turn around and all. Let them keep making money. Let them keep giving away companies like this, because they're still not trading at, for companies that are producing record cash flow. Here's where they're going to get their big kick, Gary. When we have this real slowdown economically, no later than 2026 or even a recession type, and there's finally a couple of flat quarters of not real growth, and all of a sudden money managers are going to say, hey, the only companies that are showing up growing are these mining companies. Anybody know anything about this? That's when they'll come around to it, but not before.
Well, this has been a wonderful discussion. I just want to welcome everyone to this fantastic interview who's watching with Peter Grandich. Before we wrap up here, and I have my final questions for Peter, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community. Receive a free report. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. That's a famous quote by investing legend Ray Dalio. It's also the title of the report. I'm positive that you've been enjoying the conversation that Peter and I have been having. Please let him know. Hit the like and subscribe button and leave a comment below the video. Peter, before we started hitting record, I mentioned to you an asset ranking lightning round. I'm going to ask you to rank assets 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give 1 or 2 sentences as to why you take the position. We'll roll through these pretty quickly. Okay. All right. So gold on a scale of 1 to 100, is it a buy or sell, and why?
Buy 100, nothing better to own at the moment in my book.
Gold miners, 1 to 100.
90, because for some very people that can't afford any type of risk, maybe not putting a lot in it, but they are going to be producing free cash flow for a lot of quarters, should only work higher.
Physical silver, 1 to 100, and why?
Well, somebody that was not bullish for silver for a lot of years always viewed it as second class, but thankfully when it broke under 30, I turned just in time. I think it rivals gold in terms of equal ownership, and I think it has its own argument and should even surprise people at times and actually lead gold higher.
Silver miners.
I don't look at them strong enough, because for a lot of years, silver was just a byproduct of major producers. So I don't follow them enough to give you a qualified answer.
Okay. Copper, 1 to 100, and why?
99. just to leave that one point out there. I think it's a great product. I think the world is in desperate need of it. And I think the keys are going to be is companies like one I'm invested in that have gold and copper, because copper can be very intensive and costly to develop. And so if you can get to gold, which is much cheaper, you can lower your capex. And so gold and copper combined project is probably the most attractive thing you can look for.
Uranium.
Near perfect storm, went back in it again after fortunately getting out and making the best I ever made in stocks. Don't focus so much on the day-to-day price because it's almost meaningless compared to other metals. The world is not going to live on wind or even solar. It's going to need large-scale nuclear, and you need uranium to have nuclear.
Do you make a distinction between uranium and uranium miners?
Yeah, because the key in uranium is own the producers or the people that own the physical before the juniors. There's not a lot of them. There's only a handful of the publicly held companies and all. And therefore, I think they have to be bellwethers. If you're going to play uranium, I think you should be overweighted with the companies that produce it versus just trying to find it for the first time.
Okay, so the uranium miners, what are you giving that?
I would give it a 90. It's pretty close, but again, there's some
Focused
risk.
on the producers. Yeah.
Yes.
Yeah. All right, let's move over to oil.
Probably 50. The issues I have is I still think it's an item that can get lower in price, and the shares are just too expensive relative to where the physical price is. So I don't think there's any reason yet for me anyway to get involved in that market.
Okay. Let's shift over to the general market, the NASDAQ.
-5.
Okay.
So a very low number. It is probably even more riskier than the Dow because it's so technology driven. I know we're near the top, Gary, because bankrupt companies that are in bankruptcy, are seeing their stocks double or triple. And that always happens at near the end of a move, not in the middle or the beginning.
So are you, real quick, are you seeing in your crystal ball, are you seeing a .com part 2 kind of environment?
I am seeing that for some of them. I'll just tell you this. If you look at a crystal ball long enough in this business, the only thing you become an expert is how to eat a lot of broken glass.
Right.
Well, I don't know where the future is, but I can tell you if history does tend to repeat itself, the market now is showing a lot of speculative excess that in the past has caused it to peak.
Okay. S&P 500.
I'll tell you this much. I don't mind some country stocks outside the United States. There's much more attractive valuations outside the United States. Emerging market stock valuations versus the U.S. are probably at one of the most historic lows, and the dollar going lower will be beneficial to them. So if I had to err owning equities, it would be equities outside the United States.
Okay. So are you under 50?
Yeah, I'm not a big fan of the U.S. equity. So I'd be in a very low number.
Okay. All right. Short-term treasuries, 1 to 100 and why?
Well, 100 because that's where I am. I got out of the bond market at the end of 2021 and told people for at least 3 to 5 years bonds will lose money. And people looked at you, even people that I worked with, and said, Pete, we were trained. You go into stocks for risk and bonds for safety. How could you tell people they're going to lose money in bonds? Yet people that put money in 21 and 22 are down over 50%. So I love T-bills and CDs of 1 year maturities or less. I think it's the safe than sorry place to be.
And the long term, what would you put? I know where you stand on the long term. You just said it. What would be your number?
0, because I think the shock will be is they will eventually lower rates possibly as early as September, but the shock will be like the last time they lower rates. The short end goes down, but long rates go up.
Okay. Scale of 1 to 10 representing each one representing a percentage. Where do you see inflation ending the year?
Right about where it's at. So I guess that'd be 5 then. I'm either bearish or bullish.
Okay. And 1 to 10 probability that we're going to be in a recession by the end of 2025.
Well, we won't know that till the middle of 2026, but based on that, I think it's probably a 7 or an 8.
Okay. Finally, the recommended portfolio, as you just pointed out a moment ago, 60-40, 60% stocks, 40% in bonds. By ownership standpoints, there hasn't been any gold in anybody's portfolio in an awfully long time. What percentage do you recommend precious metals and precious metals related equities to be held inside of a portfolio? And what bucket or buckets are you pulling from?
So I don't believe in the 60/40 because I don't believe in cookie cutter. I never give a standard portfolio suggestion, even when I was licensed to, because everybody's different. I do think you own gold. I used to tell clients this: own gold and hope it doesn't go up. And the response always was the same, Gary. Excuse me, Mr. Grandich, why would you want me to buy something that you don't think is going to go up? Because if it goes up a lot, what you currently own a lot of is likely to go down. So first treat it as insurance minimally and hope you never have to use it. But I still think it could be a capital gains opportunity. And I certainly, if you took two of the most precious things in my life, my wife and my daughter, and said you get them back only if you pick the one that either goes up the most or down the least, stocks, bonds, or gold, I will choose gold.
Just based on what you just said and what we were talking about earlier with the K-shaped economy, do you see a potential environment where everything goes up together? Maybe not, excluding bonds, but everything else.
We basically have had that, if you think about it.
Yeah.
We've had that. It can't go on forever like that. There's going to be a divergence. And the more likely one that's going to diverge in wrong is the one that everybody's already bet on. And it's clear where Wall Street has made their bets: stocks and cryptocurrencies, not gold.
Okay. Peter, this has been a wonderful discussion. Really enjoyed it. Always enjoy our discussions. Would you let everyone know where they could learn more about your work and how they can connect with you?
Well, about the planning side of it, petergrandich.com, the website, but where I put interviews like yours on a YouTube channel I have, but where I do most of my commenting is down to an X page. And so that would be the simplest and easiest place to go. And it's at Peter Grandich on X, or what we still like to call Twitter.
Okay, wonderful. Well, I'll put all that information up on the screen. Everybody can click through the description area. Peter, again, always enjoy it. Thanks for being here. Look forward to having you back on sometime soon. Everybody else, thanks for watching.
Thank you, Gary. God bless.
Wrap up here, and I have my final questions for Peter. I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community. Receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. It's also the title of the report.